السلام عليكم ورحمة الله وبركاته. Managerial Accounting New Chapter Pricing. Lecturer صلاح شبير. Learning objective number 1: compute a target cost when the market determines a product price. When the price is assumed on the company, we want to determine the target cost التكلفة المستهدفة. Learning objective number 2: compute target selling price using cost plus pricing. تحديد selling price بطريقة الكوست تكلفة زائد cost plus pricing زيادة على التكلفة. Use time and material pricing to determine the cost of service provided. استخدام طريقة الوقت وماتيريال المواد المستخدمة في تحديد تكلفة الخدمة. The last one: determine a transfer price using negotiated cost-based and market-based approaches. تحديد سعر التحويل بالتفاوض أو في ضوء أسعار السوق. The first three learning objective deals with pricing to customers outside the company, but the last one to determine price internally between divisions or branches of the company. Target costing هدف من عملية حساب التكلفة و what price should we charge. هذا السؤال في غاية الأهمية. What price should we charge, which can be considered pricing objectives: gain market share حصة السوقية, achieve target rate of return تحقيق معدل العائد المطلوب, demand طلب, price sensitivity حساسية السعر, environment political reaction to prices, patent or copyright protection, cost consideration, fixed and variable costs, in addition short run or long run. To answer this question, what price should be charged, we consider all these factors: the pricing objective, the demand, the environment, with cost consideration. The price of a good or service is affected by many factors. Determine the price يتأثر بعدة عوامل منها. Company must have a good understanding of market forces والسوق, where products are not easily differentiated from competitor. Goods prices are not set by the company, but rather by the law of supply and demand. Such companies are called a price taker. في حالة البرودكتس المنتجات اللي فيش فيها فروق بتكون البرايس مرتبط بالسبلاي اند ديماند, قوانين العرض والطلب, والبرايس بيكون مفروض على الشركة. where products are unique or clearly distinguishable from competitor, goods prices are set by the company. لما يكون عندي البرودكتس يونيك مميز عن المنافسين, تستطيع الشركة وضع البرايس حسب تارجت برايسنج شغال عليه. Establishing a target cost. Loss of supply and demand significantly affect product price. قوانين العرض والطلب أكيد بتأثر على البرايس. To earn a profit, companies must focus on controlling costs. شركات حتى تحقق الأرباح ممكن تعمل controlling أو تركز على جانب controlling على الكوست. Requires a setting target cost that will provide companies desired profit. وبالتالي if the price from outside the company determines the desired profit, then reach to target cost. Target cost that provides the desired profit when the market determines a product price. Target cost when the market determines the price. Market price less desired profit equal target cost. If a company can reach its sales target, reduce its profit, its product for the target cost, or less it will meet its profit goal. If the company produce the product with target cost, it will realize desired profit. Establishing a target costing. First, company should identify the segment of the market where it wants to compete. السوق اللي هتشتغل عليه. Second, company conducts market research to determine the targeted price. The price the company believes that will place it in the optimal position for the target customer. Third, company determines its target cost by setting desired profit. After we determine the targeted price, we discount desired profit, so we reach to target costing. Last, company assembles a team to develop a product to meet the company's goals will intake as we see in this exercise. Target costing fine line finance is considering introducing a vision cover for its funds. Market research indicates that 200,000 units can be sold if the price is no more than $20. If Fine Line decides to produce the cover, it will need to invest $1 million in new production equipment. Fine Line requires a minimum rate of return of 25% on all investments. Determines the target cost per unit for the cover. The desired profit for this new product line equal amount to be invested 1 million times desired profit rate of return 25% equal $250,000. Each cover must result in a profit equal $250,000 divided by number of units. 200,000 units equal $1.25. Market price $20 less desired profit 1.25 equal target cost per unit $18.75. Target costing. The target cost related to price and profit means that price and desired profit must be determined before cost. The price with desired profit must be determined before cost. So the target costing is the difference between the price and desired profit. Another way to make or determine pricing: cost plus and variable cost pricing. Another way to put prices here: cost plus or variable cost plus. Cost plus pricing. In an environment with little or no competition, a company may have to set its own price. When a company sets a price, the price is normally a function of a product cost plus pricing. It's easy method: cost, total cost, variable cost, plus desired profit, we reach pricing. Approach requires establishing a cost base and adding a markup to determine a target selling price. Cost plus pricing, we determine the cost and add markup so we reach target selling price. Here, selling price less cost equal markup or a profit. Determining the proper markup, a company must consider competitive and market condition as supply and demand والcompetitive in the market. Size of markup, the plus depends on the desired return on investments for the product. Return on investments equal net income divided by invested assets. The cost plus market up equal target selling price. Here is exercise. Think more products and corporation in the process of setting a selling price on its new video camera bin. It's a functioning bin that will record up to 2 hours of audio and video. The per unit variable cost estimated for the new video camera bin as follows: direct material, direct labor, variable manufacturing overhead, variable selling and administrative expense, variable cost per unit, $60 per unit. In addition, Syncmore has the following fixed cost per unit at a budgeted sales volume of 10,000 units. Fixed manufacturing overhead, total cost 350,000 divided by the volume of production 10,000 unit, cost per unit $35, fixed selling and administrative expense $30, fixed cost per unit at 10,000 units $65. Syncmore has decided to price its new video camera bin to earn 20% return on its investments. Return on investments of 2 million. Expected income required rate of return 20% times investments 2 million. These are profit 400,000 divided by the number of units 10,000 unit equal $40 per unit. These are return on investments per unit $40. Now we want to determine the selling price per unit. Variable cost $60, fixed cost per unit 65, total cost 125, المارك-up desired return on investments per unit 40, so the selling price per unit at 10,000 unit 165. Cost plus pricing. We determine the variable cost 60, the fixed cost per unit 65, total cost 125. We add the markup per unit to realize 20% return on investments, $40. Selling price will be $165. Cost plus pricing, use a markup on cost to set a selling price. It's easy. Compute the markup percentage to achieve desired return on investments of $40 per unit. We want to compute the markup as percentage. Markup desired return on investments per unit 40. A total unit cost $125. So the markup percentage 32% from cost. Markup percentage 32% from cost. Total unit cost زائد الماركب بيديني total selling price. Total unit cost 125 plus المارك up 125 times 32% equal $165. Cost plus pricing. The previous method to determine price has limitation of cost plus. Advantage of cost plus pricing, easy to compute. Cost plus pricing الادفانتج تبعها easy to compute. We compute the total cost and then add target profit, target return on investment. We reach the price. Disadvantage للcost plus pricing doesn't consider demand side. Will the customer pay the price? Fixed cost per unit change with change in sales value. At lower sales value, company must charge higher price to meet desired return on investments. Again, cost plus pricing. The advantage easy to compute. A disadvantage doesn't consider demand side, as with the customer pay. Will the customer pay the price? Third, fixed cost per unit change with the change in sales value. At lower sales value, company must charge higher price to meet desired return on investment. Limitation of cost plus pricing. If budgeted sales value for 6 months uses was 5,000 instead of 10,000, the previous exercise, we now assume that we will produce only 5,000 cover. Variable cost per unit would remain the same. However, the fixed cost per unit would change as follows. The fixed manufacturing overhead for 350,000 divided by 5,000 unit 70, fixed selling and administrative expense 300,000 divided by 5060, fixed cost per unit at 5000 unit 130. In the previous exercise, the fixed cost per unit at 10,000 unit was only $65. At production, sales volume 10,000, fixed cost per unit $65. But now at level of sales only 5,000 units, the fixed cost per unit is too high, $130. In a think most result 20% return on investment now result in $80 return on investment per unit. Again, total cost $190, markup desired return on investments per unit $80, selling price per unit at 5,000 unit 270. At 5,000 units, how much would think more markup its total unit cost to earn a desired return on investments of 80 billion. يعني هنحسبه as percentage desired return on investments per unit 80 divided by total cost 190, return on investments 42.11%. Again, the cost plus the pricing, when we need to invest $2 million to earn 20% return on investments. If the level of sales or production $10,000, the selling price $165. We mark up per unit only $40. Percentage 32% from total cost. When when we produce a lower sales value 5,000, the fixed cost per unit increase to 130. Also, the markup per unit increase to 80. So the selling price very low, very high, 270. Will mark up percentage high, 42%. Variable cost pricing, alternative pricing. Alternative pricing to avoid disadvantage cost plus pricing, we can apply variable cost pricing. Simply add a markup to our variable cost. Avoid the problems of uncertain cost information related to fixed cost. Per unit computation helpful in pricing special order or whether excess capacity exists. Major disadvantage is that managers may set the price too low and fail to cover fixed cost. Cost plus pri- Cost plus pricing means that selling price equal cost plus markup percentage times cost. Cost plus pricing in two ways. The first, cost consider total cost. The second, cost consider variable cost. Air Corporation produces air. The following per unit cost information is available. Direct materials $16, direct labor 18, variable manufacturing overhead $11, variable selling and administrative expense $6, fixed selling and administrative expense are $50,000, and fixed manufacturing overhead is $150,000, using a 45 markup percentage on total per unit cost. Assuming 10,000 units, compute the target selling price. Using a 45 markup percentage on total per unit cost and assuming 10,000 units, compute the target selling price. Compute the target selling price. We compute the total unit cost. Direct material, direct labor, variable manufacturing overhead, variable selling and administrative expense, fixed selling and administrative expense, fixed manufacturing overhead, total unit cost $71. Total unit cost 71 plus المارك total times markup 45%. The selling price per unit equal $102.95. Time and material pricing, will take it in the next recording. Thank you.